US President Donald Trump announced sweeping tariffs targeting countries worldwide, aiming to impose reciprocal tariffs based on how he sees they treat the US. He declared this as Liberation Day, claiming it would be the rebirth of America. It's caused a bigger crash than even GFC and the dot-com bust in year 2000. It caused the biggest single-day stock market crash across global indices since the 2020 COVID pandemic. US trading partners like the European Union, Germany has warned of negative impacts to global economy and trade wars, and in fact China has retaliated by now going into an arms race and saying we will impose 34% higher tariffs on US goods coming into China. Experts warn that this may lead to a global recession, so in this episode we'll go through what is the impact of the tariff on the global economy, starting with the US. What is the impact on China, which is a very important trading partner with Australia? And most importantly for us, what is the impact on Australian house prices? We're going to go right down to the city and types of houses that will most likely be affected. I'll try to bring you an objective episode free of any politics so you can make better decisions with your money right now.
Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you.
Let's start here. US tariff duties collected as a percentage of total imports. Now, I think everyone knows that a tariff is simply a tax on imports. It's not the person exporting it that pays it, but the importer pays it. It's an additional fine or fee or tax on top of the existing price of the good or service. It's intended to be a disincentive to import because now it's more expensive, and instead incentivizing local production, local demand, and shoring up the local economy. We're going to go through later in this episode what this means for global and also Australian interest rates and how that relates to the local economy and house prices. The Liberation Day or 2nd of April announcements take the tariff amount to approximately 25%. It's never been this high since 1909. So this is a shift in how the US government wants to engage with the world. It no longer is in caretaker mode, whether that was right or wrong, but rather is taking care of number one first, just like it did back 100 years ago. Now, tariffs can be inflationary and tariffs can also be deflationary. In other words, they can cause prices to rise because if demand for imports is inelastic and people continue to import those goods and services despite them being more expensive because of the tariff, that means prices have risen and demand stays constant. But they can also be deflationary if businesses and consumers can't afford that new price, and therefore they start consuming less and investing less, and therefore the economy starts to shrink, or at least doesn't grow as fast as it used to. Trump, I feel, is hoping for a deflationary effect, and that's why he's calling on the US Federal Reserve to lower interest rates fast, and he's trying to abolish federal income tax in the US so that demand for overseas goods and services doesn't evaporate, but that demand is reallocated to local goods and services. In any case, the Atlanta Fed nowcast currently points to a contraction in US GDP. It's suggesting that this year the US GDP might actually shrink by negative 1.4%. Of course, this is fresh news and a lot of people have a lot of opinions and perspectives of what will happen. In a trade war, may escalate or it may de escalate. There's so much water to go under the bridge, but let's just continue to consider the facts. What we do know is that the performance of major indexes over the last month, whether it's the S&P, the Dow Jones, the tech-led Nasdaq, they've all been down, and especially since the April 2nd announcement, they fell around 5%, which is just massive. This was as big as when the COVID pandemic first struck us in March 2020 and all hell broke loose, so to speak. But as we know, the stock market is easily spooked. This dip may turn into gains within a few months. So let's not draw any massive conclusions from this other than the fact that analysts right now can't really understand how Trump is going to achieve his long-term vision of bolstering US manufacturing, bolstering US GDP, and bolstering the purchasing power of the US consumer. What's most important for Australia, however, is how China reacts, because China is Australia's #1 trade partner. China, in response to the US's overall 54% tariff increase since the start of this year, it went in tranche of 10%, 10%, then 34%, decided to retaliate, unlike Australia, and it's imposed a 34% reciprocal tariff on imports of US goods in retaliation. Keep in mind, so far they haven't retaliated to the same level as which the US has imposed tariffs this year. So they've retaliated a lot, but not one-to-one basis. What does this mean for Australia? If China is hurt by these tariffs employed by the US government, then it's likely the US will demand less goods and services from China, which will in turn mean that the rate of growth in China's economy, its GDP, will fall. Now, it's China that keeps Australia alive. We are the lucky country because China wants what we have. According to Trading Economics, these are Chinese imports from Australia. Ever since 2017, they started going up, and now it's to the tune of $150 billion of Chinese imports from Australia. These are predominantly in the categories of ores and ash, so like iron ore, minerals, fuels, oils, salt, sulfur, earth, stone, plaster, pearls, precious stones, materials, cereals. If China's economy is shrinking or not growing as fast, that will mean it doesn't need as much of these inputs to production as before, especially when it comes to iron ore and minerals and stones, which will in turn mean the Australian economy exports less, receives less export receipts, and our own GDP is compromised. But I feel there needs to be some context. China's GDP, even before these tariff announcements, has been flatlining since about 2021. You can see since 2000, it started going up at a very fast rate, over 7% per annum GDP growth. But in the last 4 years, it's been pretty flat. Australia has still survived, but the biggest danger is if this GDP level starts going downwards or stays flat for an extended period in time. That will mean areas in Australia, especially exposed to Chinese imports, are going to suffer. What comes to mind is predominantly Queensland and WA, with its minerals, coal, and iron ore exports. All of Australia relies on its resources sector, not just these two states, but those are the ones that will be in the firing lines, so to speak. Now, of course, China's not going to let its GDP fall without a fight, so it's recently announced a $41 billion plan to boost consumption, which is just the start. Policymakers last week doubled subsidies for consumer trade-in programs to 300 billion yuan this year, matching market expectations and again steering clear of cash handouts. This is an expansion from last year's 150 billion yuan program announced in the summer. Last year, China announced ultra-long bonds for consumers, trade-in policy support, as it was worrying that its GDP was stagnating. Authorities announced that they would allocate 300 billion yuan in ultra-long special government bonds and expand existing trade-in and equipment upgrade policies. There have never been such specific measures aimed at consumption, the Bank of China's chief researcher Zhong Liang said in an interview. What most people might not understand about this is that previously, when China's economy was rocky, it used to stimulate it by building cities, by building infrastructure, which required a lot of steel, which in turn, for production process, required a lot of iron ore. That was beneficial to Australia because we sell them iron ore. Their strategy is now changing to stimulate the economy. They're no longer building their way out of a recession or deflationary experience. Rather, they're injecting juice into its consumer society. China wants to be less reliant on American imports for its survival. Rather, it wants to be self sufficient. It wants its growing middle class to start buying more. And so it has its own ecosystem of production and consumption, a consumerist capitalist society, much like the US in the last 50 years. What this means is that its new idea of stimulus isn't a get out of jail free card for Australia. Not going to simply get on the phone with Albo and say, send us more Earth. That's not going to happen. So, what does this mean then for Australia? Are we going into a recession? What will happen to our interest rates? And then what will happen to local Australian house prices across different cities? Fixed income futures are already now expecting in May there to be a 50-50 chance of a 0.5% or 50 basis point interest rate cut in Australia. Not a standard 0.25%, but a 0.5% cut, taking the interest rate to mid threes. And that could just be the beginning. Even though the US's tariffs on Australia aren't great, they don't affect us so much because we don't export so much to the US compared to our other trading partners. But there's indirect effect that I'm trying to paint a picture of through China that could significantly take the rug from underneath Australia's economy. Therefore, economists and analysts are expecting significant interest rate cuts. Now, country level share of fixed rate mortgages. Australia has a very little share of fixed rate mortgages compared to almost every other country around the world. What this means is that as soon as interest rates drop in Australia, Australians are very sensitive to that because their mortgages all of a sudden become cheaper. Whereas, let's say in the US, you have 30-year mortgage fixed rates. So interest rates go up or down. The normal consumer isn't immediately impacted. This means that we don't need too many interest rates to restart the economy or give it a bit of gas. But it also means that small reduction in interest rates can light a fire under consumer habits and also house prices. In fact, CoreLogic shared a chart where it said that median value of house prices versus a 1 percentage point fall in interest rates mean that both units and houses generally increase in value. You can see units in the orange, houses in the black circles. If interest rates fall by 1 percentage point, that means that the majority of dwellings, which is on the right hand side of this line, right to the zero, they increase in value. Of course, units are cheaper, and that's why they're in the orange cluster down the bottom, predominantly under $1 million. But given the trend line is bottom left to top right, that's the general direction of the scatter plot, suggests that more expensive houses generally rise more with interest rate reductions. Of course, where are the most expensive houses in Australia? You're thinking Sydney and Melbourne. I'm going to get to which of Melbourne versus Sydney I'm most bullish on based on data with these imminent interest rate cuts in a second. But I know many of you are probably thinking, PK, great, interest rate cuts, house prices higher due to increased borrowing capacity and easing the pressure of consumer purses. But that's only going to happen on the backdrop where unemployment is rising because we're heading into a recession or something similar. So how are house prices going to rise if all that is happening? Well, here's a very important chart with the data predominantly from the Australian Bureau of Statistics. Rolling annual change in home values versus annual average unemployment rate. This is really interesting. I think it might shock a lot of people. In the blue, you have the unemployment rate, and in the orange, you have home values. So when the unemployment rate generally increases, you'd expect the orange line, home values, to drop. But they don't. So there's not a direct relationship. And the reason for that is monetary policy or interest rates and used more liberally these days than 20, 30, 40 years ago. As soon as unemployment starts to tick up significantly, rates are lowered. And so even if there's a moment in time where house prices do correct, if rates are lowered very fast, then that injects cash and money supply into the system. Unemployment starts to come down again, and house prices get a healthy boost. So knowing that interest rate drops mean that upper quartile houses perform the best, which are Sydney and Melbourne. Which of the two perform the best? The difference between Sydney and Melbourne median dwelling values hasn't been this wide since 1999. Sydney has outperformed Melbourne, especially in the last decade, and in the last 5 years, Melbourne has been largely flat despite the national COVID boom that Australia experienced. Now, the difference between Sydney median and Melbourne median house price is 53%. The last time the price disparity was so significant, Sydney continued to go up post year 2000, but Melbourne went up so much faster. Therefore, the disparity came down, as you can see in this period up to 2014. Price disparity between two cities is an incredibly accurate way to forecast price growth. And if you have been on this channel for a long time, you can see that in 2021, we accurately predicted that the Gold Coast was going to boom based on its price disparity to Sydney. And it continues to do well until it reaches long-term equilibrium price disparity across other major capital cities. Now, this doesn't mean that only Melbourne is likely to do well with interest rate drops. There are pockets of regional New South Wales, regional Victoria, Brisbane, other places in Australia too, which are already growing by double digits, and interest rate drops will be a case of rising tide lifts all ships, but especially those ships that were already going very fast and very high. So overall, we need to be mature and learn the lessons from history, especially COVID. It's a troublesome time in the global economy. We're reliant on China in a big way, but monetary policy and money supply, it has the biggest sensitivity to house prices in Australia. And as soon as the RBA smells of something even close to a recession, that monetary policy tap is going to be turned on, interest rates will come down, and despite what's happening overseas, and despite short-term unemployment blips, house prices are likely to do quite well. I don't know how long we're going to remain the lucky country like this, but Australian residential real estate is as blue chip an asset class as you'll find globally. Not to be compared to commercial real estate, which is much more volatile, in tune with global ups and downs. And I think this next 1, 2, 3 year period might be very juicy for the Australian investor. Hopefully this was objective and brought you value. My name's PK. Thanks so much.